Hi, this is Randy Finney with the right side of the chart, and this is an early session update for Thursday, July 3rd, 2024. Just keep in mind we have 4th of July tomorrow, Independence Day. Markets will be closed. So let me get some updates out. I fired a few updates off to you today. This week is a low volume trading week, obviously because of the U.S. holiday. Yesterday I got after the last post, I took the rest of the day off. But I want to update you, and I fired off a few today, but I'm just going to do a quick video kind of highlighting the core trades I've been focusing recently. We're going to go through in this order: equity markets, treasury bonds, crude oil, natural gas as well. Oh, forgot to write that down here. I just took a long in nat gas. Silver and gold and the euro, that all kind of ties together. I covered that quite a bit yesterday with the correlations there and the reason for these indirect hedges I've done or pure play trades. And then finally that soybeans, still my favorite of the grain, the agricultural commodities right now. All right, so NQ, the last update gave you before yesterday. We had a breakdown here. We've had 3 trend line breaks, one which we're back to right now. You can see NQ. The Nasdaq futures are just slightly above that previous high when the day they put in the bearish engulfing candle. They haven't taken out yet. I think QQQ moves slightly higher. There's a discrepancy there. Remember, you're going to get that too. The Nasdaq futures will trade. You're looking at 24-hour around-the-clock trades, other than the brief 1-hour shutdown every day from 5 to 6 p.m. Eastern. Other than that, they trade from Sunday evening all the way through Friday evening, just shutting down on the weekends there for a little bit, Saturday and some of Sunday. So that's what we're looking at, and what I've drawn here. Oh, well, let me give you the last update. When we broke this trend line, I said objective short entry, as would any pushback to the trend line, but not above. So I had stops there set yesterday. I'm not fully out. Took a partial. I just wanted to lighten up because the way it works, I'm going to get to my daily, weekly chart in a second, show you incrementally. So now that we've taken that breakdown, that last one has failed, and we're effectively testing the highs again. NQ a hair below, QQQ a hair above. It's incrementally increasing the odds we're going to hit that max bounce target. I feel pretty confident in those targets I gave you a week ago, and I'm going to go over those in a second. And I'll talk about how it works. It's incrementally. You can just say it this way: from those previous highs up to that bounce target. I'll get on the weekly. The odds go up. When I told you yesterday I was about coin toss odds 50-50, then they increase at 50% and go up. So every tick up, 51, 52, 53, you get to that max target, which is only 5% above 5.5. Then you have a 100% chance. Now, you might say, Randy, you say nothing's ever 100% again, because that would be the range. If it's up here, this is the 50% mark, where I think if we pop it, because we've now taken out that trend line, it increases that, but it's still coin toss odds. And so coin toss odds, like I said, are just that, roughly 50-50. But then you get up there. Now, what I drew here, you're still going to have, if we do put in the futures here a new high anytime soon, and especially on the weekly and daily charts, but even here on the 60-minute chart, you're going to have the same divergence that was in place at this high right here. And at this high rate, well, no, that was a smaller divergence. This is the big divergence, the main divergence that's been building here on the 60-minute charts. So that's what the futures look like. And so therefore, it's just, going to stay in that roughly 50% range, maybe a little higher. This is that weekly chart I'm talking about. And so this is that max bounce range, 511.74 on QQQ. Market top range, I called it, and gave that to you a week or so ago. With, being that it was the top of that level there is only 5.5% above that June 20th peak. That's the day we put in the bearish engulfing candles when I was on vacation last couple weeks ago. And that's it. So that's what I mean by incrementally higher. We go up there. And, if you get up there, obviously you're at 100%. And like I said, if we get there anytime soon, which I expected even back then when I gave it to you a couple weeks ago, or a week or two ago, I said if it happens, it's probably going to happen relatively fast. We'll punch on through there, stops will be cleared, and we'll get up there. So that's, in a way, I'd like to see how it plays out, but that's what I think it'll be. In other words, we'll probably be there by the end of next week is my guess if we're going to go there. Remember, because tomorrow we're shut down. for trading. And that's it. So the outlook remains the same. The technical posture remains the same. Volume continues to just plunge here. I've covered my low volume indicator many times with you. Let me just jump to the 60-minute chart. This is what it looks like on the 60 right here on QQQ. That's not my main board. That's my main board right there. So you can see, unlike the futures, we have a slightly higher, but still very much divergent high. And then my low volume indicator, I got to go here. What I had started to work up a chart, but I'll just cover those individually and showing you how well those hedges are working. UBT is I could have thrown out to you the other day. I trade the future, so I'm a ZB guy, shorted ZB. I'm sorry, went long ZB. But UBT is the 2-time ultra. I'm going to turn it off now. Long bond. In other words, they track. It's an ETF. It's like TLT with 200% leverage. And so that would have been the comparable investment to go, long. Whether, again, pure play, the case I made to buy treasuries, that support, everything else. But also, like I said, it was almost a guarantee, in my opinion, to see the Nasdaq go higher. You'd have to see two things happen. Treasuries most likely go higher, which they did. And again, a lot more, like I mentioned, hopefully that was clear. Take a double-sized position in treasury bonds. The rally of the last 2 days was, since from where I posted, it was 2%. Profit, at least if you did it over the 2-time beta adjustment, you did better than that against the gain at the same period in time. I measured from when that trade was posted, screenshotted up to there was a 0.25% gain in QQQ. So 8-fold upside offset or profit in TLT. And I'm going to get to those in a second. What I wanted to show you here, where is that board? I have a board here with QQQ. Got to go. Oh, that's right. I got to go to daily time frame and talk about my volume indicator. There it is. I had it right here. Again, we're seeing volumes. Ignore the lines up top. That's for something else. This is that low volume extreme. This had been kind of where we'd get to for a while, but this is the low end of the range. The only last 2 times we got there is just before COVID. This was COVID right there, that 36% drop in the S&P 500. Nasdaq fell a little less than that. And then we almost hit it right there, right before the market peak there. And again, it just shows you conditions, just like divergences. They're not hard sell signals because low volume can stay low and quite a while, quite often does for a little while, at least a few weeks, couple months. But often I can go back. I've used this indicator for years, and sometimes it's one and done. You had that extreme right there before the big Q4 2018 drop. That was one of the biggest drops, corrections that we've had in many years in the market. And again, so I've covered that before. And I just want to point out, it's not going to get any better this week with the, abbreviated, trading and all that, low volume. So you have all that stuff is there. And again, my degree of confidence is high that range I gave you on QQQ that I'm playing, this is the way I'm playing it, market top range is going to be it. There's just a mountain of evidence pointing to a significant top, significant correction coming up. Everything from put call ratios, sentiment, market breadth. I mean, those are big ones, and those are things that over time and time again you see it's the same story. The handful of fewer and fewer stocks. The big, most beloved, whether you go back to the Nifty 50 back in the day in the 70s, or you go to, the same subset of big tech stocks that had led the narrow advance up to the 2007 market top in October, then followed by the big drop. So that's it, guys, and we're just waiting for that the sell signals to come on a. Why is this? Okay, I've got a line chart here. Back here. Sorry. Go back to the regular board here, weekly chart, and this is what we need to see. There's the weekly chart. That's where this chart was originally put out a week or so ago. And this is that weekly uptrend line in which a solid, meaning you don't have to squint, close below it. Right now, we're still above it. We've had multiple tests, 1, 2, 3, 4, couple intra-week breaks. They don't matter on a weekly time frame. 5, 6, 7. All that matters is the weekly close, and I have a high degree of confidence it's going to be a big red one when it comes, whether it comes from the top of the range or anywhere in between. So that's your update on the equity markets. Now let's get to the other stuff real quick. TLT, I already gave you an update there. That's it. You had 2 bounce targets. There's the uppermost one. I had a similar downtrend line from, I guess it was off these points in ZB. ZB are the futures, and ZB is effectively there now. Let me get to that for you. And now look, you do you, I'll do me. I took off because that was it. I wanted to just hedge up to this point. I've also lightened up on my index shorts, and may even close them out today. The rest of them, I don't, I'm not. When I see a reason, I don't see a reason right now because we regained that trend line I started out the video with on the 60-minute chart. In other words, if I wouldn't short something at the moment, did very well last couple of days with these offsetting trades, and so on TLT I've taken out, but I've actually added to crude, and I'm going to add to that. I'm going to get to that in a second, and just took natural gas as well. So this is it. And like I said, if you want to remain either hedged as an indirect hedge against the equity markets, because if bonds rally, it means rates are going down. That's net bullish. That would support the case for the rally up, that other 5.5% upside in QQQ, about 6% in SPY. Would be bonds rallying. And so, like I said, because of the inherently low volatility, if you didn't catch it before, I talk about it all the time with Treasury bonds. That's why I typically use a 2-time beta adjusted position size, meaning twice the weight you're going to put into index shorts or anything like that. Because volatility cuts both ways. It's less volatile on the downside. Your percentage gains that you're going for are smaller, and therefore you can use much larger position size in trading stocks. All right, so that's that. ZB. I already give you an update on this. We're same place. We're just a hair below that trend line that I was targeting. And again, being the fact that TLT is at the comparable target I gave you, which a price level, then that to me, let's take it out. And it can and probably will go up if the stock market continues to go up. But that was it. That was me. I wanted to get in and out, get the hit and run, hedge up. And now like I said, I've shifted this money over and rolled it into, let me just roll into CL now for you, crude futures short. Okay, and then my logic was first and foremost based on technicals, but also just that whole negative feedback loop. I've been covering that for over a year now. I don't have the chart I created queued up, but it showed interest rates and inflation, the cycle of that. When they abate, then the stock market will rally. And when the stock market rallies, that then indicates to the bond market, the stock market's expecting future economic growth, and therefore that brings up interest rates. And again, you can just trade it. And so, and this is the big one on inflation. That was this is the poster child for inflation, crude oil, right? So crude's been going up. It's getting hot in the hot part of that orange zone that I told you about. And again, I have, as far as a pairs trade, I've had a very high degree of confidence on this. It's not a big trade so far. I just shorted. I told you yesterday morning. So far, it's profitable, and it's certainly more profitable. Again, just this alone, the drop in crude has more than offset the gain in the against the Nasdaq 100. But once it breaks this level, I'll even add some more to that. So consider it a pure play short. This is again CL crude futures. You look for these divergent highs. These futures roll, so my charts change. That was a divergent high there. Breakdown, downtrend. This is a divergent high. And again, we're pushing back. The most important thing, fundamentally, this is technical analysis. This is charting. This is why, when that level breaks. And here's targets. By the way, guys, I gave you targets right there. These are all price target support levels where reactions are likely if you're looking to trade it. This is a sweet spot right now, very what I call HPT, high probability target, about 80.34 with this level break. So go down there or call it a minimum target, whatever you want, even though that's the first target there. That's technically the minimum target, 81.82. But 80.34, that'd be a 3% drop. And if that happens, then a 3% drop in crude is going to equate to, if the stock market goes up, it's going to offset any of the gains, and this will probably fall faster. And again, we're right on the trend line. But let me show you for you USO traders. I know I get that. Not everyone trades futures. Understood. USO, there it is, divergent high right there. Negative divergence. Last time we had a divergent high right there. You can see what happened to it, and nice big drop. And then on the daily chart, remember we're in my orange zone. I've talked about this quite a bit, and it's the same thing. Yellow zone is kind of, not great for the stock market, but no, the orange zone, they're color coded. Orange is more significant. And the last time, as I mentioned to you yesterday, last time I highlighted both USO in my orange zone, getting up to the top of the orange zone, and then IEF in the comparable orange zone, meaning 10-year Treasury bonds. We had the biggest drop in the stock market in all year, actually. And so here we are again, back to where we were then. Stock market, QQQ is trying to run at new highs, yet so is crude's running at multi-month highs. And again, no guarantees, guys, but my degree of confidence is high in this paired trade. One or the other. You're not going to see anything's possible, but I think extremely unlikely to see crude oil continue to rally, especially to get into my red zone, which is where the market freaks out. Remember, it's just kind of like IEF, the bonds in reverse. And there's correlations there too. If you think this is just random too, that this is falling, this is when crude's falling, inflation falls. Or I'm sorry, when crude's going up, bonds go up, and that's when bond prices go down, rates go up. Remember, you're looking here, IEF is the Treasury year bond, 10-year bond, 7 to 10-year bond. So when prices fall, rates are going up. That's why that is in opposite. It's bad for the market. Yellow zone, stock market starts to take note, which it certainly did then. Orange zone, stock market really starts to take note. And again, that's when we went down there. There's April, the last time it was mentioned, we were at the orange zone, went down there. I'm sorry, this was April right there when we crossed into it, and that was when we got the biggest correction in the stock market because of rising yields over last year. And then, of course, red zone. We haven't gotten there yet. If we do, it's very clear. Stock market will start to freak out. So that's it. Trading that way. Okay, so to reiterate, just so you know my thoughts, there may be more upside. Certainly not like I often do when I close a position. Quite often, if it hits a final target, I think there's a good chance that's the end of the trend. I'll short it. I'm not shorting treasuries. I'm just out. Took the bounce, got the quick 2% or 4% beta adjusted gain. Got out. But crude, I'm sticking with. Even added to, and then took nat gas. Threw that one out recently. That one, the last trade didn't pan out. We've had several this year. Traded this with near impunity. The last long entry here didn't work, so that's one that got stopped out. I'll show you in the futures in a second. However, time to go back in it, and for two reasons. Number one, first of all, always for me the charts. So you're looking at UNG. I'll just start there since I was on my regular ETF charting program. This was divergent low at support. We hit these divergent low here. We hit T1. Never violated the any reasonable stop based on the targets, and then boom, 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 hit T4. Went up there. We got out of T4, reversed it there, shorted that pullback, and then we shorted it again, I think in here off the trend line again with that divergent high. Last long entry was there. That got stopped out. I'll show you on the futures. That was below support, but now we are back to support. So back in, what I'm seeing here, you have this extreme oversold. This is your RSI, shows you how oversold or overbought something is. That's the most oversold we've been since back here, and that gave us that last time we were that oversold was followed by a rally of about 25%, and then we put in divergence. Now remember, that was a bottoming play, so that oversold reading was just a bear market rally followed by what I'm still viewing as the end, the low right there. And that's where we're going long. We're buying it here. A lot of evidence. And again, I'm not going to get off track here and go into my longer term charts. It's a different program I don't have queued up, but I showed you the long-term chart of natural gas in making a case that it's probably bottomed and is going to begin a new uptrend. And that's the way I'm looking at it. So essentially, I'm viewing this as the first leg up, a little corrective wave here. And this trade, I think, has potential to, even though we don't have my beloved positive divergence on this pullback, at least not on this time frame, I'm at this point in time, I'm allowing it to be a runner, potential runner trade. What does that mean? Well, that means if, here's a target right here, that last place, we took a shot at it right there. That was actually the level. I'm going to move that line now because it comes into that low and that gap there. And so that's a very obvious and minimum initial target right there. That's going to be about from where we're at right now, about a 5% gain. And then these are the old lines are old targets, but they still hold true. Remember, this was my T4 back here, hit, and then you can see how well it acted. These levels, it's just amazing how well technical analysis often works. It, then became reaction low. They bounced. They bought it there on that reaction low. Then the gap down below it, that's a sell signal, went down, tried to rally up, failed again, but then broke out. And once it broke out, resistance then becomes support. Successful backtest, boom. Another successful backtest, boom. Another successful backtest, boom. Another test of it, and it finally broke that support, and boom, lights out. So that's that. I'm going to pull this line down too. So eventually I have to just drop these off because I'm borrowing those lines and tweaking them. But that's now the support level. So there it is. And let me show you futures. I still have this as an old board. That's the June contracts when we were trading it here. Remember we were buying it here on this support level here. Hit my first target, pulled back to it again. The key support hit second, third, fourth, fifth. Then put in that divergent high, and then we had another trade there. But that contract's no longer trading, so I'm going to close that window out and get you the current one here. Okay, we're on the August contracts. Price support. Why did I buy it? Price support 2.4 or 2407 right there. Decent price support. Positive divergence, which I like to see. That was a divergent low there. That was a divergent low. Those are periods where I went long. And this is divergent high, short, divergent low, rally, divergent high, drop. Simple stuff, right? And it either works or it doesn't, guys. That's it. And then here, stops are right here. That was the last time I highlighted right here. There was a support zone. Bounced the first time, then it took it out. And that's where, and you can see what happened when support, and there was a pretty well-defined support zone. So that's where logical stops would have been placed. And brings us back here. And that's the next objective entry with a stop somewhat below. And targets, minimum target 2.64 or 264. That's going to be about 10%. And then there's this downtrend line that comes into play. And again, like I said, to me, it has the potential to be a runner trade, meaning, you can active trade it. That's just what I do. It's in my nature quite often. But then, or just let it run. If it gets profitable, just periodically raise your stops. And let it run, because when natural gas wants to run, she really runs. There are times she'll waffle around, consolidate, but typically the trends are what I call unidirectional. She's either going full throttle up or full throttle down. And I call it the widowmaker too, because if you don't know what you're doing, if you don't beta adjust your position size, what does that mean? Well, don't put as much in natural gas as you put in treasury bonds. If you do, you're going to be super happy when it goes your way, and you're going to be really upset when it doesn't. It's all about position, size management is very important. This is a volatile security. You don't need to put a lot in if you're targeting double-digit moves on your swing trades. Okay, and for those of you wondering, well, Randy, you just told us the other day you shorted crude. You're bearish on crude oil right now, and yet you want long natural gas. Aren't those, they're two energy sources, competing energy sources. So, however, and there are times they move together, but there are times, especially recently, and when you're looking at correlations, most important thing are your recent correlations, and they're almost perfectly inversely correlated recently. There are times you go back and you'll see a positive correlation, but this is going back to the late 2023 right here, and you'd see they were positively correlated at one point, but then they started going the other way. You have UNG in white, so UNG and USO, crude oil, in orange. And so you had natural gas rallying while crude was falling. Then crude started rallying, right? And natural gas exactly was going opposite. And then you had a big rally here in crude oil and a big drop in natural gas. They both ended around that time. Big drop in crude, big rally in natural gas. Complete negative correlation there. And so that's another reason that I'm short and bearish crude oil and long natural gas. You can also consider it one of my indirect hedges, right? Natural gas really is, they're related. They come, they're coming out of the same wells a lot of time. But the point is, if I'm wrong on one, then maybe the other one will play out and I'll be right. Either way, they're both based on their own technicals first and foremost. But again, they if things go well, things go well, they both work out. that's the easy part. But and then I was saying maybe one doesn't work out. So it's also a form when you have multiple assets. It's another form of diversification. Okay, and if you're wondering why the stock market rallied yesterday, why my silver trade's on fire and doing well, and again, another indirect hedge, it's all this right here. The euro, as mentioned, we had a divergent high there. We had a sell signal there, highlighted at the time, went down, stock market dropped, gold, silver went down, we shorted those. Then I started getting bullish on the metals here because of this, because of the likely rally for the euro. I highlighted again the other day, divergent low, i.e. positive, aka bullish divergence. And so it's little doubt in my head. Again, I've showed you the correlation. It's nearly immutable, very, very tight positive correlation. So this started to play out, and we had a nice rally yesterday in the stock market because of it, and gold and silver and everything else. So and this also supports, if we're going to see more upside in the euro, it's going to bring the stock market up to those max bounce targets, another 5% or so higher. It's also going to most likely bring gold and silver. Like I said, silver is always usually my go-to. All overweight silver. You just get more bang for your buck, or just trade it outright. So silver, this is the chart I gave you recently. Divergent low at support. Made a long entry there. Again there. And just in the last couple days, silver has rallied 7%, up on 3.25 right now, and that's next target. And for the time being, I may add additional targets. I'll let you know if and when we get there. Gold too, doing well because the euro's rallying. Simple stuff. T1 hit, T2 is right there, and again, I'm considering these also an indirect hedge. Being long the precious metals. Why? Because if the precious metals go up, it's most likely because the euro is going up, euro US dollar pair. If the euro US dollar pair goes up, the stock market goes up. So again, these are vastly outperforming the stock market recently with that rally in euro. They just have more response, if you will, to it. Plus, stocks have been getting tired. Breadth is still abysmal. You still have the equal weighted indexes. Even the small caps are lagging now, which is kind of an ominous sign. Oh, and I'm seeing credit spreads finally starting to widen. We'll do that in another video. But even the small caps, which love falling rates, just can't get out of their own way. Remember, the small caps started a bear market back in 2021, which are still very much in, or at least very far off those highs. And even lately, kind of sucking wind. Just like everything else, equal weighted, Nasdaq 100 still below its 2021 highs, and equal weighted S&P telling a completely different story. These aren't yellow flags, guys. These are red flags for the market, and the momentum's there, and it's going to continue. And if the euro goes up, buy programs hit, and they'll buy stocks, and then when the turn comes, like I said, it's going to be it's a game of musical chairs right now. Right now, the music's playing. But I think it's just perfect time to take these indirect hedges, and if they're played right, then you more than offset any losses. Again, if that's your thing, if you want to keep a little core position of shorts right now, waiting for those sell signals to go to a aggressive all-in moment, when we sell signal being break of the uptrend lines on the daily and weekly chart of QQQ. But all right, last but not least, so there's your updates on equity markets, treasury bonds, crude, natural gas, the precious metals, and then soybeans is told you a few weeks back, the best looking grain in my opinion. And then wheat and corn will run with it most likely, but this one had the most constructive chart by far. And that's it. Nothing big, but it continues to rally up another 7.75, 0.75% today, coming off that divergent low at long-term support. And for you active traders out there, we hit T1 today to the button right there. I had it at 11.26 and a quarter, although I do always suggest selling a little shy of that level. I believe that was the high. Where's my pop-up box? It's not popping up. I've got to change the setting. That was, I think, the high of the day to when my first target, 11.26 and a quarter. So the way it works is, now, wait for a breakout above that level, and that should open the door for a rally up to T2, T3, T4. I'm going to end the video with just trade ideas. I had 2 alerts go off in the last couple days. One was on this one, but it would I didn't highlight it. I got the alert. I got the alert on what's the first Tuesday. It appears I have a price. I'm going to reset the alert if it's not already active. It should still stay active, but I'm waiting for this one. It's a short setup. NXPI semis. Like I said, most of the semis have long since peaked. Nvidia and just a select few are at or near highs. This one just had a beautiful. That's an island top right there. It's a gap up. Gap up. Or a candlestick separated, a topping stick separated by gaps on both sides, came with positive divergence. I think I could just draw the heck out of this chart if you want. You can just draw a nice little head and shoulders topping pattern there. If it can push up, it's already made enough to effectively give you a right shoulder. There's your neckline. So there's 101 reasons, in my opinion, to short on a solid break of 263. I have it at 263.06 since we punched it intraday. When I get these alerts, I look, make sure everything, what's the market doing, what's the stock doing. So that's it, right, 263, and that should still be my alert. Probably duplicating this 3 times over. And then the other one was today. I got an alert on it, but I told you I would wait for a break above the trend line. See, it's punching intraday. This is IPGP. And also a semi, but again, it's just the charts there. Nice support zone right there. You could buy it at the bottom of the support zone, like I said, with a stop somewhat below. It's just one of the better looking semis. This one trades well to the technicals. I don't have it. You see my lines, but I don't have the letters there. This is a divergent low right here. You can see the positive divergence I have drawn. I'm trying to arrow tool it, rally. And then you had a correction that ended with a bullish falling wedge and a divergent low again. Rally. You ended with a divergent high, followed by a correction back to support with a bullish falling wedge and a divergent low. Rally. And now we have positive divergence. So although if the semiconductor sector takes it on the chin once this market tops and we get it's probably not going to play out to all these targets. It could. I'm just sharing a chart. It's a clean looking setup, and there's always that if I'm wrong thing. So if the semis haven't topped and have a lot more to go, this one I would say would outperform. I would 10 times over put money in this over Nvidia. Of course, I'm short Nvidia. It's my biggest index short position. I have a very small position in NQ, which again I might close out today. Close even a smaller amount of it yesterday with stops that were hit. But this one, that was even a bigger divergent high right there. Yeah, just much more attractive. This looks like closer to a bottoming play than a topping play. But again, it is a semi, and birds of a feather tend to flock together. I'm just going back in time, showing you how this thing just trades so well to these technicals with these divergent highs and lows and trend trade. But all right, those are just 2 I had in the last few days. I have a gazillion price alerts set, and I want to share that. I have a lot of trade ideas. I'll go through a video for individual stocks with you in a little bit. I'm just looking at this guy here. It's a trendy little sucker, and I just wanted to glance the long-term chart. That would also be quite bearish, by the way, guys. When if you get in a bear market, sometimes you get these nice-looking bullish setups. And they fail to materialize and they play out, and that's quite ugly. So 79.60 is that long-term support I showed you on the daily, about $80. I'm calling, and again, a break of that, especially if the divergences are taken out, that's uber bearish. But as of now, here's the stock at support with a nice clean downtrend line in which to trigger a long entry. So there it is for you guys looking for long trade ideas, especially in the semis. I'll stop it here, and then, if you want individual names, let me know. I've got a lot of alerts set, a lot of setups, long and short, right now. but kind of waiting with where market conditions are. The risk reward is just not. We've got a kind of cross current, little yin and yang thing going on. You've got the momentum with the big tech stocks that hasn't broken yet, nor have the uptrend lines off the April lows. So on that side, it's hard, to get a lot of these short trades playing out. On the flip side, the individual stock long trades aren't playing out either. The only things going up are that just a handful of the same names, and they just don't have. I've highlighted again for you. It's not as if they haven't had, and I've said it 100 times over. These are objective levels to go long, especially NVIDIA on the trend line support there. Again on the trend line support. I've said this repeatedly. If you're bullish, you buy NVIDIA at the same levels. I'm waiting for a break to add to a short position. So there are, objective long entries on pullbacks to support on these guys. But other than that, when you get to new highs and things like that, the only thing you can do, there's Microsoft. There's now you have to wait for a pullback. This trend line's been sliced through, so it's no longer valid. I'm going to remove it. So things like this, there's just no. When you're at new highs, you have to wait for a pullback to support. It's going to be all the way back down here. But then that's going to mean it's coming off this big divergent high. And that's, to me, just not objective. It's not my kind of trade. So I'll continue to hunt for the individual stocks like the one I just showed you, IPGP and others that look good. Both long and short, and then you guys decide what to trade. But for now, I'm spreading, I've got a shotgun. It's somewhat concentrated, simple portfolio, but things that are either uncorrelated to the stock market completely, like soybeans, or inversely correlated, and those are making good hedges or pure plays. All right, I will stop the video here. This has been Randy Finney with Right Side of the Chart. Have a great day.